Okay, in this video, I want to show you a little bit how you attack a problem, a typical problem in the CFA on this total returns. Okay, so it's a margin investment return. So an investor buys a stock on margin. Assume the interest rate on the loan and the dividends are both paid at the end of the holding period. The data related to the transaction are as follows. Okay, so we have some number of shares. We have a leverage ratio, which immediately tells us, that if you want, we can reverse this one over 2.5. Um, we would find that 40% is the margin. Okay, we don't need it, but that's just to give you a bit of a just to give you a bit of an idea here. The first thing that I want to do, I want to give you a big picture here. Here's a big picture without actually looking at the answers yet. We want the total investors return. Okay, my favorite way to go about this is to first say what would have been the unleveraged return, ignoring any commissions and any dividend payments. Okay, so your stock went from 32 to 35 plus the dividend, 0.55. That's what you actually got. So you got an extra $3.55 on your $32 investment. If I pull out a calculator and I find that 3.55 divided by 32 gives me approximately 11.1%. Okay. And now immediately, if you want, if I didn't have any commission or anything of that sort, I know that the leverage ratio amplifies that. Okay, so immediately, without doing a lot of calculation, I have an upper bound. So I multiply this by 2.5 times 2.5. I get 27.7% approximately. So if I go to the answers, this is not really going to help me, okay, very much. But I know that the answer is not going to be 13. Okay, all of a sudden I've doubled my chances of getting the right answer just by realizing this. And actually I can go a little bit further there without actually calculating the precise thing. The commission, I can ignore it because it's very small as a percentage. Okay, so it's going to eat very little on a percentage from my capital. But the call money rate is 6% per year. Okay, and I'm holding this for 6 years. So if my leverage ratio was 2, I would have to pay 3% of my initial money. Okay, so one way to think about it, remember you have a leverage position. Let's say the leverage ratio is 2 because it's easy to say. Then you have $1 of your own money and $1 or the equivalent of that of other people's money. Okay, so if you're going to hold their money for 6 months, you're going to pay 3% interest. Okay, so really what you're paying here is 3% interest on 1.5. You take the leverage ratio, you take away 1, which is the money that you have, then you're going to pay interest of 3% on 1.5 times your initial capital. So that is equivalent. That is equivalent to um, 4.5% of your initial capital will be eaten away by this interest that you pay, right? So immediately from there, I already know that I had this 27.7 minus 4.5%. Okay. This gives me the 23.2%, and I immediately could go with this answer. Okay, because again, the commission prices are going to be too low to actually change anything for me, right? But let's do it a little bit more. So if I was sitting in the CFA, I would probably have continued on with this question. I would be confident enough that the spread in the other answers is big enough for me to just say 21.84, and you need that speed on the CFA. Now, you're not always going to be able to do this, but you almost certainly will be able to eliminate one answer that will be immediately obviously wrong. Now, if you want to calculate this precisely, then you're going to have to do a little bit of work, right? First, you have to understand some of the assumptions of the CFA. So the buying commission is paid by equity. And the leverage only applies to the gross purchase. Okay, so when you think about gross cost of shares, you're excluding commission, which you have to pay, is 600 right? We had 600 shares. We bought them at 32. So 600 times 32, we have $19,200. This were our total fund, which were leverage. We already know the leverage ratio, so we can easily find our equity. Equity is total fund, which is 19,200 divided by the leverage, which is 2.5. So my equity is 7,680. Okay. You could have also done this by realizing that it's 40% of this, right? So what's the margin, right? What's the share that out of those gross funds you're putting your own equity? Okay. But this is only part of your equity because remember, one of the assumption is buying commission is paid by the equity. Okay. So to this, as initial equity, um, we will be equal to this 7,680 plus the commission that you're paying, which is tiny, right? What is the commission here? Is 600 times 0.08, and that is $48. So effectively, you're saying that my total investment outlay is going to be $7,728. Okay, um, that's my initial equity, right? And then I'm now going to look at what's going to happen to my profits, okay, in comparison to this initial outlay that I've given up. Well, let's think about this. So what are we going to do next? We're going to sell. What are we going to sell? We're going to sell 600 600 shares that we're told are selling at 35. We're going to make 21,000. If this is our equity, we can subtract it away from the 19,200 to figure out our borrowed amount. So borrowed funds would be equal to 11,520. Well, I need to repay those borrowed funds minus 11,520. But the people that gave us money didn't give us money for free, so they also want to get paid some dividends from they want to get paid some interest, sorry, from their outlay, right? So we will have to figure out the interest on it. Okay, so the interest is 11,520, right, times 0.03, because we're only doing half a month, half a year, so only half of the six will be our interest, and this is equal to 345.60. You could have simplified this step by simply saying, I'm going to return my capital times 1.03, adding that extra interest that I'm going to get, right? What else? I'm going to pay commission again. How much? Well, the $48 again for commission. That's going to be peanuts, but I'm still going to have to, if I want to be precise, I'm going to have to take care of that. And finally, I'm going to have a positive amount here, which is I'm going to receive dividends, right? You could also just think of the dividends as just a higher price per share, okay? And you could, instead of doing it as times 35, you could immediately say, well, what is the dividend that I'm getting? I'm getting an extra 55 cents or 0.55. You could have made the adjustment immediately here, so you don't have to actually think about it because it's just your money. You own that dividend. Um, and of course, we could do the dividends, which is 330. You can sum all this up in your calculator. If we haven't made any mistake, our net proceeds are 9416.40. And if we look at the return of this, um, final balance 416.40 minus initial outlay 7,728, which is what we found here, divided by the beginning outlay, 7,728, gives you approximately 21.84, which is exactly what we want here, which we were able to find by that eyeballing method, which a lot of the CFA level one could be done that way. And in fact, if you could do it with the eyeballing method, in my view, you show that you understood the question a lot better than just mindlessly following step one to step five of the CFA. I hope this helps. I'll see you on the next one.